Welcome, this is your host, Jack McKeag, and we're going to call this episode Total Financial Collapse and what to do about it. Okay, well, we got what you need at libertyaid.org for sure to help you out of a jam. I'd like to go over first. This guy's got a really good video on this topic, and it's not like I agree with everything he says, but overall, pretty much, he's going to explain demographics to you, and it's pretty easy to see here that during this time here, from the late 30s until 1961, basically. I mean, the early 30s. There was what's called the baby boomers, and this is when there was this huge uptick in amount of births. So there's a large amount of population gain in the United States during that time. And he goes through the demographics of the averages, basically. And since we're talking about the economy, we're talking about the averages. And what's going to happen is pretty easy to determine. Not on the exact day, but pretty much approximately what's going to happen. Based on the population. Because what's happening basically is this population is aging hugely, and there's no and then let's see, we got here, after that time, basically the Vietnam War and the riots and the oil embargo and all that stuff. Times got hard and interest rates went through the roof, to compared to what they've been. And so when times are rough, like during the Depression, right, birth rates go down because people are like, I can't feed children. So that's what happened. Birth rates went down here. There was a bit of an uptick here during the 70s and 80s, right? But it wasn't like this huge wave of people that showed up. Okay, that was a major change in the percentage of who's here. That was a huge uptick, and it hasn't happened since. So what's happening is this ended in 1961, actually the year I was born. So I'm like the last boomer, basically, and there hasn't been any thing happening here. Like the millennials kind of came through, Generation X or whatever, a couple little bumps here, but basically there's been no enormous prosperity like in this time. It hasn't happened, and there's no projection for it to happen, just the opposite. What's happened is, the collapse in 07, 08, right, that made things even worse. So that's a huge fall in births for a really long time there. And so what does this mean? It means that, and I suggest you watch this video because he goes over this topic very well. There's very few videos I can recommend out there. And demographics is the biggest driver of what's going to happen. Think of it this way. Okay, here's all these people. They have families, and they built all these houses. When like in 1961, your peak buying year, when you buy the most stuff, is when at age 46. He'll tell you in this video. So, what's 46 plus 1961? That's 2007, basically, is the last year somebody's going to make their biggest purchases. So it's been declining. This group has shown up with lower people and lowered expectations, is showing up right here. And so the peak of the buying happened here for this group. For this group, it peaked here. And it's just going to be going down because the population is going down. So what does that mean? It means that, this huge wave of people that needed big houses and had lots of children and so on, and built the suburbs and that whole thing, like, there's no one to fill up those houses with all those bedrooms and live that life. They're not coming, okay? They don't exist, and it's just going to continue like that for a while as expectations are lowered over time. So basically, we got to you have to understand that population is the main driver, and economics kind of drives the population at that time, but it's what happens is there's a delay in this to see what's going to be happening over the age-adjusted time periods of a lifetime, like what you may buy or something, what may be the your biggest purchases, like during this time. A consumer spends different things at different points in their life, like nursing homes, and it's getting a little small here, it's hard to read. Let's see if it'll come up a little bigger there. Nursing homes out here, prescription drugs. See, in your life cycle of the average population, there are bigger things that you purchase during different times. Okay, here's when it peaks at age 46. That's when you're buying, basically, that's when you're buying all the bedrooms for the biggest house you can get, because you got your teenagers. And then they leave the house, basically, and don't need as much room, and so on. Your spending goes down because those people leave the house. But this is really when your spending like ramps up when you have children and you need that big house and you're working hard and all that. And then it goes down over time. Okay. So how does that relate now? All right. It relates because there's been a thing called quantitative easing that the Fed is doing, and now there's a thing that's going to be called quantitative tightening. What do those words mean? Obviously, they're hiding something, right? So we can look and see the collapse happen here. The interest rate was already low. In other words, they had a very relaxed lending policy, but then they sort of tightened up. They made it harder to get money for a short period of time. They tightened up the rules of who could borrow. How is money created? Money is created only in one way, okay? And that's an individual goes to a bank or a lender and asks for a loan, they call it, right? You sign a piece of paper, you give it to the banker, right? And the banker electronically gives you, or in a check, rarely ever anymore, but gives you, right, in God we trust notes. So it's a trade, a promissory note. So how are the in God we trust called dollars? We'll use the colloquialism of dollars, but they're in God we trust notes. And so here this is how they say, okay, we're going to lend out dollars, right? Any bank can create money when somebody comes in to sign for a loan, right? A quote loan, but it's not a loan, right? But they come in to make a loan, and then that bank, as sort of a branch of the Fed, is allowed to create dollar bills. Okay, they create them, and then that promissory note goes to the Fed. The physical promissory note you sign goes to the Fed, and they make, like, say that individual was there and they signed to get a mortgage from the bank or any other lender, right? The Fed lends to every lender. So, or the Fed lends to banks and banks lend to other lenders, right? Anyway, so Someone comes into the bank, they sign that piece of paper, it gets traded to the Fed. The Fed bundles them together, right? And creates mortgage-backed securities, right? Now, they make a bond, they buy it with a bond, right? Oh, we're gonna pay you back, right? That's what they say a bond is like we have our own credit card basically, and we're gonna issue dollars out there, but since nobody has any money right now, those mortgage-backed securities and bonds and anything that the flip side of what was needed to create those dollars at the bank to lend to people. Guess who bought those? The Fed bought them. So in other words, they issue dollar bills, but they bought them themselves on credit, right? On credit that they created themselves. So that means people were paying for their bonds, right? They were paying for them, and their mortgage-backed securities, the things that are on the other side of those dollars that people sign, right? They're bundled together and sold on the stock market and sold on the different markets. But people weren't buying here. They weren't buying enough of them. So, in other words, um, they were having trouble making dollars because no one was buying the thing that backed the dollars because there wasn't enough money to do it. So they started buying them. Right here, this blue line. It's called quantitative easing. 1, 2, 3, right? And there was and that's what they did. The Q3 was Q infinity, basically, saying, "Hey, we can just do this anytime we want." So what does that mean? See, look at this: federal asset holders, federal holdings of treasuries. So, they were buying the treasuries that back the dollar, and they were also buying other stuff that was being lent out there for any other dollars that were being lent on, car loans or mortgage-backed securities they call them, but that's all loans basically. Everything that's not a treasury is all this, and they bought an unbelievable amount, obviously, to stimulate the economy, basically, because here's I said the population was like done. We don't want any more of those giant houses and giant cars and all that stuff that you're building and selling and stuff that's left over because, well, there aren't as many people, there aren't as many families. And the Fed is like, well, how about if we make it really easy to buy that? How about that? We'll make the loan we give you, let's see, here we go. This is the Fed funds rate, right? And this is where it's been, right? 0. So, since 09, basically, 08, 09, until very recently, just recently, it was 0%. In other words, the Fed was giving all banks money for free, basically. If you get anything on any of these, mortgages or anything, you can keep everything over 0%. In other words, you keep all the interest you can charge these people. It's really, quite a stimulus to the banks. Think about it. The Fed's like, we'll give you all the money you want to lend out to people, and we won't charge you for it. So anything you can make on lending to anyone you want over this entire time period, go ahead. They made some rules and constraints, but they obviously removed a lot of them. And then in this period right here, they're beginning quantitative tightening, which has just recently begun. Here it is. Let's go over what they call quantitative easing and tightening. Okay. See, this is them just buying back everything, 0% interest. In fact, in Japan and the euro, they're negative percentage. In other words, their central banks are paying the banks to take their terrible money. The U.S. is like, well, You know, because they've just loaned it out to everyone for so long at 0%. Now we're negative, so it's like they practically can't give it away. And so the U.S. is going to be like, I'll tell you what. Now you know, because their economies are not growing, the prices for things are growing, and people are having, you know, harder time paying for them, so they're dropping the rate. So everything seems like it's rolling along okay, but if you're just giving out free money to the banks, they're going to lend it to anyone they can. Everyone and anyone, it doesn't matter what. They'll make up any story and get anyone in, right? That's what happened back in '07, '08. It was the collapse of that. So now what's happening is, for a little while, you can see that the euro and Japan, they don't give interest rates out from the central bank. And so their treasuries have, you know, the things that back them, their government securities. Why would anybody buy a government security if they're not getting any interest on it? They're buying them themselves only, pretty much here. Okay. But now the U.S., they put as a percentage of the money out there that they have, they've just been pushing out way more money than like per capita to this QE thing over in the euro and Japan than the U.S. has done. The U.S. has done it too, just not as much. So they're going to pull back here a little bit, as they've done, and basically everywhere in the world, you want a government-backed security that pays some interest rate. Well, only the U.S. has got them. So money starts to flood from all over the world towards the U.S. to get in these, you know, oh, that's safe money. At least you can get something. But I mean, look, who would do it? Well, if you were a bank and you could get $100 million and you could get 2% interest, you know, as a difference here, well, you make 2% interest on $100 million. That's a like $2 million. You know, multiply that times a billion. You see, this turns out this spread here makes these dollars go towards the U.S. securities so they can get some money. And so they're like, oh, so what do? This is quantitative tightening. In other words, now, where is this thing? See, what's happening is now the Fed is going to sell some of those mortgage-backed securities and so on that they got. See all this? They were giving money away to everyone that wants to borrow money, right? So then they stopped giving away as much. They held it steady. Now, excuse me, they're going to sell it over to the Eurozone, right? And Japan and so on. Because again, you can get some dollars here, you know. So a lot of big institutions and big money switch over to the U.S. And that's how they sell them. And that's why Japan and the Euro, all those countries, you know, basically, and you know, I'm not talking about China and those things. China's in its own giant mess too. Similar but worse. Only real place these days is India, think about, because they have a rising population coming up. Nowhere else really has it, of an industrialized nation. And they're getting industrialized, so it's actually, that's a good place to invest. Anyway, so here's their buyback and the reason. But what's going to happen then? What is going to happen? See, here's a more up-to-date chart here. Basically, you can see that whenever these kind of gray areas here are huge economic downturns, I think, basically. Yeah, recessions. There we go. And so you can see during a recession, they got to drop the rate, you know, in relation to the recession to bring it back up. So, see, they're always kind of trying to take the most money from people possible. Here's where this huge ramp up of population kind of ended, and in this area, this stagflation happened with these high interest rates, and a lot of money went to those loans. So, anyway, you can see since then, the interest rates have never really recovered so they can charge that much. And every time there's a recession, they have to do a little bit more. And now we're down at 0. Okay, so they're going to try and bring it up here, but every time you see they're only going to bring it up a little bit more, right? And then what's going to happen? What do you have happen after it goes to 0? You got to go negative. So they're going to raise it. That's going to what? Destroy the economy, right? And make it slow down. And there's no population to come in and like boost this thing, to buy these homes and so on. Let's see how this plays out in the day to day. All right, let's use a concrete example. I pulled one up. You can buy a minivan now in great shape in a lot of places for very little money. This thing is in great shape. Look at this. It's clean. Look at that. It looks great. This thing and I could pull up 100 minivans like this in every place. Very affordable. Look at it. It's in great shape. Who wants a minivan? They're uncool, right? But they move a lot of people, right? Large family, easily transports 25 miles to the gallon. Great. Pretty good on gas for moving that many people. But what do you see everybody driving around now, right? New giant pickup trucks, new everything. Because why? It's easy to get money lent on a car. You can pay for it maybe if you keep your job, but if you lose it, and when interest rates climb, businesses don't have as much money, they don't expand, there isn't as much demand, they slow down, right? So people start to lose their jobs. Well, right now, what do? You can see this collapse is coming in mortgage prices, in real estate prices and everything, and they're tightening up. In other words, the interest rate is rising, so it's hard to get a loan. You have to pay more. If you have to pay more on interest, what happens to the price of something? It comes down. If you're paying 0% interest, I'll buy your $50,000 car. What? Because maybe your payment is like, okay, it's $800, but if the interest rate goes up to 5%, you can still only afford $800. What does that mean? It means the price has to come down, right? Of the $50,000 car, it's got to be now 40,000, right? So when the interest rate goes up for people in the current situation, and they are in their current situation, raise prices. Situation's the same; it didn't change, but the interest rate changed. It went up. Well, people can't afford to pay more, so they're not going to pay more. Their new truck, new everything sales are going to go down, and so on. Right now, it hasn't really kicked in fully because you can buy all these brand new, not brand, in great condition, older minivans. Like, they're everywhere. They're a great vehicle and a smart vehicle to get. No payments. A lot of car payments, like you get a new minivan, that's like, with all the, whatever this had, that's going to be like $400 a month. This is 3 months of a car payment and is paid for, Like, I got a $450 minivan about a year and a half ago, and I didn't put any money into it, and it just finally died. And insurance for that was $50 a month. So when you're coming into a time of economic collapse, you don't want to be going in there with high payments every month, because a lot of people are going to lose their jobs, which means they're not going to be, even if you don't work as a job, you have people as clients. Well, they're going to have less money, okay, to give you for the work and so on that you do. So every with higher interest rates, everyone's thing slows down. But with higher interest rates and no population, like pushing the demand with just, hey, we're having babies, we got people, we got to get in somewhere. That's not happening. That those people don't exist to come in. They're less, okay? They're way, way, way less. So you can see these baby boomers, you know, they got these cars, and now they're getting their, I'm old now, so I'm going to get like a little car, a cool car, the car I always wanted because I don't have to have children around, right? That's what they do. They, you know, on average, okay? Not every individual, but people are doing this. That's why these like really great condition minivans, piles and piles of them on Craigslist are just sitting there because money's so easy to get for like the car you really want on the car lot or whatever. But you're not really thinking it through very clearly. You're just thinking, man, I'm making a lot of money at my job and whatever. You're just thinking about today, but those payments will stretch on for like 6 years. I mean, this meltdown is going to go from soon, at most 2020, to like 2023 in that time period, because and then 2023 some of that population comes back in and the Fed will boost again, whatever. But this really, 98% of the value of, like, think of it, 100 years ago, when the Fed started, a little more than 100 years ago, anyone could buy a house for a few $100s, right? Anyone. Like, that was real money back then. Now it's like, well, wait a minute, really nice house with a piece of land or whatever, that's like $500,000, not $500. With like a yard and all that stuff. That was like normal. Everyone had that 100 years ago. You had a big yard, whatever, right? 100, if you spend $500, that's a house. Now it's 500,000. So, we're really that's taking away 99.9% of the value of the dollar. That's what the Fed has sucked out of, the Fed Reserve has taken away everyone's wealth, 99.9% of it. You can see it just from doing the math there. In just over 100 years. Really great Ponzi scheme they have going on. And it will, of course, collapse because how much, like negative interest rates, how long can you, like, what do you got, negative 10 interest, how hard do you got to push the sales of these God We Trust, promissory notes, the dollars? Like, it's next collapse is going to go, negative or negative. Now we're just in negative. They're paying us to take their crappy money. No, there's going to be another solution that I'm going to go into in the future that's going to replace the system. Not many people know what it is. Maybe no one but me. But I know what it's going to be. But right now, you need to be aware of this. So I had a client saying, well, I'm thinking of getting a piece of land now. Well, money's easy to get, so I'm thinking of getting some land. Okay. For what purpose? Like, do you have an inelastic price to what you're going to sell whatever you make off that land for that'll last through this huge depression coming up, recession, whatever they want to call it? It's going to be big. In other words, you're like, well, let's say the property's in California. I was going to buy this land. I can, grow weed, and I'll make good money. Okay, well, what if in 4 or 5 years the price of weed goes down, more than 50% because people don't have money? Is that enterprise still making money, or now do you have a payment you really can't afford to make yourself? You follow? So you're gonna have to make some decisions, to keep your revenue going. They're not going to be easy to make. I'm saying that, and I like this guy's Harry Dent's take, that this, there's no way around a missing population. There's just no way around it. So, what's going to happen before the Generation X millennials kick in, and they're not going to kick in hard, is, the price of real estate could drop 50, 80%, starting in the next year to like 2023. Okay, it's really going to be a major downturn. So that's when you buy. Now's when you sell, when the market's at its peak. Sell whatever real estate you got. Make your money. And then, find something like a minivan to live in. And I mean that not in a live in a minivan, but a lot of people do. But I mean, like, what's the housing equivalent of that? You know what I mean? What's the dogs out there that nobody wants to live in now? Because it's just like, I can get the coolest car ever now. Why do I want to have a minivan? You know what I mean? Like, because a minivan gets you there really cheap, is dependable, and it costs nothing to insure. That's why, because that's the best value out there. So what's the best value in housing? It's kind of like, the really inexpensive stuff. Like, people are like, oh man, I want to fix that up, or that thing's too old, or you know what I mean? Like, I don't want to live in a trailer in Florida now. I'm going to build me a new house. Money's easy to get. I have a great job, stuff like that. Well, how much is that trailer? I know I could find one for under $5,000. Not that far from the beach. And yeah, it needs work and stuff, but you could do it. So what's your mortgage? 0? Just go pay for the thing and live in it. You don't have a mortgage, you know? And there's a monthly fee for some things you have, but you see, that's kind of like the equivalent of a minivan now. Like, I get it. Not many people want to live in a trailer or whatever, but in a warm state, you're outside a lot, whatever, it doesn't really matter that much. It would suck in the north, to be cooped up in a tiny place, I'm sure, that doesn't move, all winter long, but still they're, equivalents to that. You're willing to live in a cold place, whatever. What's kind of like, you'll see in the very niche bottom of the market, the things that no one wants because they can get cooler stuff. That's what maybe you want to get right now, if you want to get anything, something that people are, gonna get foreclosed on and all this stuff. They want to be able to pay cash for something. Well, those things they can pay cash for are gonna go up in price. Like a trailer, I think it's gonna be 2,500. It's gonna be like, they're going up. It's gonna be 20, 30, 40, 50,000. Something like that for a while. It's gonna be more. There's gonna increase. Whereas those giant houses and stuff, they're gonna plummet. And the rest of Florida, for example, Florida plummets like crazy because what? Because it's like vacation homes, a lot of it. Obviously the population has aged even more than it used to in Florida, in a lot of ways. So, but those people are dying. They're going to be sellers. You see that aged population of Florida? All that aging population, they die, they sell their house, right? And who's going to buy it? Well, they're never buyers. You see, so we get to permanent sellers in real estate. And, minivans, like, there's a lot of elderly, selling minivans. Mint condition, barely used, all that stuff. It's like they didn't drive that much when they were old. But people aren't getting these like nearly brand new minivans. They're going out and getting money lent for 5-6 years because it's like 0%. Oh, great. Or nearly 2%. They're like, man, this free money's, or nearly free money's going to go away soon. I better keep it up. You see? So it's kind of like this irrational, we're in this irrational, in this area of irrational expectations. Now, you can see all the factors are weighing in that it's time to get out and sell. But you can see that very few people are getting ready for this. So I'm just letting you know that this is absolutely obvious, imminent thing. The Fed knows it and is doing, it's going to ramp it up and things are going to get rough, but then there's no population to back this up too. So, and look at all the interest rates down in the negative. It's just really, where was that one? It's truly mind-boggling here. Negative interest. People still don't want their money. This hasn't happened in history. You see, we're into a place of meltdown. Like, what's going to happen is countries like Italy are going to go down first and not pay their bills and so on like that. And it's going to have this domino effect like in whatever, 07, 08, but it's just going to get much worse. For a while in there, the U.S. will look better than other places, but this domino effect will just drag down everything ultimately, even though the Fed will sell its stuff here because its interest rates will go up, but then Americans not going to have access to as many purchases and so on. So start losing jobs, and then it will be like, well, where's this big push coming from? See, we got almost zero interest. Now it's like huge tax breaks that Trump is doing, I've heard, and so on. Like, anyway, it can't, I mean, zero. What do you do next time? Negative what? Negative what? Negative what? You see, it's just, it doesn't work. The whole system collapses at some point, and we're seeing the beginning of that now. Actually, we saw the beginning of it here, but they're like, you know what? Just give them free money. Make it free. You can't just give away free money forever. Like, that's not going to work forever. It worked for a really long time to stave off the inevitable, but now they're going to do this, and it's just going to spin out of control, in my opinion. Because who's going to buy these suburb houses? They just don't work. For so much money, there aren't going to be the jobs to pay the bills every month. Sure, they're going to hike inflation and just make it go through the roof, basically, but in the meantime, there's going to be confidence is going to go away, and the mortgage foreclosures are going to scream through the roof again. And those with great credit are going to be able to pick up a lot of deals coming up here and sell them in the next uptick that the Fed makes. You know what I mean? When they go down to $0 for a while again, over here, right before the end, then because this chart's always the same, right? And it goes up, go down, it goes like this. And that's when you sell it over here. When it goes way up in here, right? Nobody can afford to buy anything. Nobody's buying. That's when you give them super low, price deal. Hey, this is when you want to short sale the bank and make money from them. Foreclosures happen. You want to sell me that house, or you just want to let it sit there? You know what I mean? So that's why doing my work on Liberty Aid and so on, getting your credit together and getting all your financial stuff together, and jackmckeg.com, right? You do all these things, you get yourself in the right place, you can make some money during this meltdown. You can be the one with credit when no one else has credit. Do you see? Okay, that was kind of a long one, but I think it was an important one. People need to really understand what's coming and go, yo, smart people drive a minivan. The smart people do. I'm sorry. It's, you look like an idiot out there in your Maserati paying $2,000 a month for what? Image? Just be okay with yourself. You don't need a car to make you cool. Just be cool and drive a minivan and save a whole bunch of money. And instead of working like a slave, like go to the beach for the day. Instead of like, how am I going to make that, Maserati payment at $1,200 a month, right? But it's so cool. I got me a Maserati. We'll just go buy a minivan and pay once, 1 month, and drive it around for a few years. No problem. You see, it's like you have to get over this whole programming of, new is better and everything like that. Living the life you want is better. Buying things cheap and selling them when they're more expensive, that's being smart, okay? Like, don't worry about the image. Quit watching that TV thing and whatever, and you'd be fine with doing smart stuff. Okay, this is imminent. This is going to happen. There's no way around this collapse. It's guaranteed. So what are you going to do about it? All right? I'd suggest you get, some of our products and some of our help, and then you'll see it through very easily. Okay, God bless your success.